There's a reason why the biggest corporations, the largest banks, the wealthiest families in America, and really the wealthiest families in the world, plus hundreds of thousands of business owners are putting cash value life insurance in their portfolio and on their balance sheet. And it is not because they got duped by an insurance salesman. Now, there's really three main reasons why they do this that I'm going to talk about in this video here today. But before I do, I want to give you some history about cash value life insurance just so you have a better understanding. Now, late 1800s, a guy named Henry Hyfe, what he did was he created the product that we know as cash value life insurance. He combined a savings component with a death benefit to create cash value life insurance. Now, this product became very, very popular almost overnight. It only took a few years for about 50% of Americans' discretionary savings to start going into these policies with these life insurance companies. Now, at the same time, right at the turn of the century, late 1800s, early 1900s, bankers caught wind of this. And what they did was they went to these insurance companies and they struck a deal behind closed doors. Keep in mind, at this time, this is pre-Federal Reserve. And pre-Federal Reserve, access to money was a lot harder than it is today. There was no private central bank that they could go to just print money out of thin air. So when they struck this deal with these life insurance companies, they got their hands on the reserves. They started investing in speculative assets, things like railroads, things like that. And they were just not being good custodians. The life insurance companies were not being good custodians of the money. It was way too speculative. An investigative journalist caught wind of this. When he found out about it, he took the story to the media. The public was outraged. Obviously, their savings are tied up with these insurance companies. And the Armstrong Commission was born. The Armstrong Commission put regulations about what insurance companies could invest their reserves in. And so that turned into things like mortgages, bonds, real estate, very safe assets, very safe investments. And so that kind of gives you some context on how life insurance companies have this 100 and nearly 50-year track record of proven consistent returns. So going back to the early 1900s, if we fast forward to 1913, the 16th Amendment gets ratified. Now Congress can levy an income tax. Well, life insurance was kept exempt, so was the cash value growth, and so were policy loans, how you access the money inside, or really the best way to access the money inside, in my opinion. Now, like every tax code, it got used and abused by the wealthiest people in America, and Congress came in. It took a while, right? But Congress came in the 80s, and they said, hey, we're going to have to make some changes. TEFRA-DEFRA came out, and basically what happened is they said, we're still going to give you the tax benefits of the tax-free growth, tax-free withdrawals, as long as you take it in the form of a policy loan. Obviously, you can take basis out. But then what they did is they said, if you want those things, you have to have a certain amount of insurance. And that's where insurance is at today, which in my opinion is a very beneficial thing. And finally, just so you know, from 1933 to 1980, the majority of savings and pension plans in the United States were with life insurance companies. These insurance companies were the custodians managing these things. Now, if we look at what happened in the fall off, well, 1978, ERISA comes out, 401k plans start to take over, and the employers shifted retirement responsibilities from pension plans, from themselves and insurance companies, and they actually put them onto the employee with 401ks. It went from defined benefit to defined contributions. And that's really where we're at today. Everyone's using 401ks, everyone's using IRAs, and it's really no surprise that we're in this retirement crisis. It was Ernst & Young that found that, in just a few years, they're going to have a $260 trillion retirement savings gap. Now, that's a topic for another video, but it just goes to show you, pre-ERISA, when we had these guaranteed pensions, we didn't have these retirement crises that we did today. There's a lot of reasons for that. I don't want to go into that in this video. This video is specifically just talking about the concept of, is life insurance a scam? Because I see that so often online, and this is such a powerful product that you could put inside your portfolio. It is going to be one of the strongest assets that you and your family could possibly have. Now, let's talk about the three main reasons that the rich and powerful put this in their portfolios and on their balance sheets. The first reason, obviously, is going to be the tax benefits. You can make near unlimited contributions. The contributions are going to be determined by the insurance company. There is no contribution limits that the government puts on these contracts, and that's what this is a private contract. And so you get tax-free growth, you get tax-free withdrawals when you take it in the form of a policy loan, and then the death benefit is going to flow back to the institution or the corporation or really whatever we're talking about, income tax-free. So great tax benefits with this, and this is really one of the reasons why they like it so much. Now, the second reason is the guarantees, the certainty that you have with these policies. Now, in most policies, you're going to have a guaranteed rate of return or you're going to have a 0% floor. What that does is give stability even times of, highly volatile market conditions. So market goes down 30%, goes up 30%, goes down 30%. When things like this happen, which they do happen, they know that they have that safety and security and the certainty within their insurance contracts, to save money. And this is really what gives a lot of confidence to go out and speculate in other things. Fidelity, I'm going to talk briefly about this. I don't want to get too off topic on this, but Fidelity started recommending guaranteed income to their clients about 20 years ago. And what that did was that gave their clients the confidence to go and be more aggressive in the market when they understood that they had a guaranteed paycheck for the rest of their life that covered their basic expenses, increased customer satisfaction by 92%. And so that uses an annuity, which is still a life insurance product, but it just goes to show you there's a lot to be said about guarantees in a portfolio or on a balance sheet. Now, the final one is what everyone hates to talk about, which is the cost of insurance, what everyone talks so much crap on the internet, but it's the concept of cost recovery. Cost recovery, what this essentially does is it allows the bank, the family, the institution, the corporation, it allows them to recover the cost, because usually these policies are for pension plans, so it allows them to recover the investment they put in by getting a tax-free death benefit. So typically, whatever premiums they paid in are going to flow back to them income tax-free. And this is how they keep the cycle going. The flywheel continues using this. A great example of this is University of Michigan's football coach, Jim Harbaugh, I believe is how you pronounce his last name. They put a policy on him, and it accomplishes these three things. He gets the tax benefits. They all get the tax benefits. He gets his pension income tax-free because he accesses the money via policy loans. There's the guarantees, and then the cost recovery. The University of Michigan is going to get their money back, but his family is going to get any residual money left over. So very powerful asset that the rich and powerful absolutely love to use. Now, I'm going to rattle off some numbers here. I have them printed out, but I'm just glancing at it on my computer. I'm going to rattle off some numbers and let them do the talking and throw some things up on the screen as I'm rattling off these stats, okay? So, over 4,000 commercial and savings banks owned bank-owned life insurance and have a cash surrender value of over $200 billion. That was of 2024. The top 5 banks, this is like JP Morgan Chase, Bank of America, Wells Fargo, etc. Top 5 banks, they hold $74.3 billion of that cash surrender value. Now, this one is always my favorite, and it's such an interesting stat, right? So during their most profitable year, which was 2013, Wells Fargo had $18.2 billion in cash value life insurance and $7.5 billion in bank premises and fixed assets. This means they had 2.5 times more invested in life insurance than their other fixed assets. So this is like all of their bank locations. They had more invested in life insurance than they did in all of those locations. Now at death, that $18.2 billion worth of life insurance, that could make Wells Fargo collect as much as $100 billion income tax free. Now, are all their executives going to die at one time? No, more than likely not. That would be, a doomsday scenario. But if it happened, they would get roughly 5.5 times the insurance in the form of a death benefit. Roughly 68% of Fortune 1000 companies fund their SERPs with COLI. A SERP is just a supplemental executive retirement plan. Side note, if you own a business, if you're watching this video and you are a business owner, you can deduct 100% of the life insurance premiums from your business. If you want more information on that, email me, jeff@hannafamilysolutions.com. 43 of the top 50 banks funded their SERPs with BOLI. 61% of companies offering non-qualified deferred compensation plans funded them with COLI, followed by mutual funds at 15%. So get that. They tell all of us to put our money into 401ks, which are mainly tied up in mutual funds or some variation of a mutual fund. But only 15% of companies offering SERPs, which is a lot of companies in the Fortune 1000, are putting it into 15% of them are putting into mutual funds, while over 60% of them are putting it into life insurance. So they tell you to do one thing, invest in mutual funds that more than likely their buddies manage, and I'm not hating on that, I'm just saying that's the reality of the situation. But over 60% of them are putting it into life insurance. Very interesting statistic. Now, this is just very interesting to me. Notable Americans who've used or currently use life insurance for the death benefit, tax-free income, and financing. Walt Disney, FDR, J.C. Penney, Ken Lewis, Ralph Roberts, Brian Roberts, Steve Jobs, Kobe Bryant, George H.W. Bush, Larry King, Ray Kroc, and millions of others. Now, why should you care? Because you are getting advice from the Pirates of Manhattan. Barry James Dyke. Highly recommend you read this book. It's called Pirates of Manhattan by Barry James Dyke. And it details, everything I'm talking about here today is from this. And it details all the finance, right? It details your mutual funds, it details your 401ks, and how you're getting tricked on that. Tricked meaning they're telling you to do one thing while they do the complete other. And they want you to do that so they can just collect fee after fee after fee, which, again, I'm not even hating on fees. I'm just saying that, they do one thing and they tell you to do the other, okay? Now, life insurance products, they're not meant to compete with Bitcoin, okay? They're not going to get Bitcoin-like returns. They're not going to get returns like any of that. You're going to get an unsexy return, a very safe, stable return that creates certainty, which creates peace of mind, and then you can go speculate with other money, right? But think of life insurance as the foundation that you build your house on. It needs to be very, very strong and stable, and that's why life insurance has this proven 150-year track record. So for you, you should consider putting this asset in your portfolio if you want the same benefits that I just detailed before. The tax benefits, tax-free growth, tax-free withdrawals, income tax-free. The guarantees, right? The guarantees safety and stability, the guarantee from no loss due to market volatility. That creates a lot of peace of mind, okay? And that protects you from sequence of returns risk, which I have another video detailing that. It's actually the video right before this, so watch that after this if you're interested. So for a second, forget the word insurance, okay? So when we're talking about what insurance is, what life insurance is, it's just simply a contract, a private contract between you and an insurance company. It's governed by the IRS, Section 7702, and what it does is it allows you to have a place to make unlimited contributions, get tax-free growth, and take tax-free withdrawals, so long as there's a legitimate insurance with it, a legitimate death benefit that comes with it. Now, in my opinion, this is a good thing. Now, the type of insurance that I always recommend to my clients when I'm talking about permanent policies is a type of insurance called Index Universal Life. So we're going to get into the iPad here, and I'm going to share on my screen how the cash value grows and then how you can access it as well. And then after that, I'm going to do some comparisons and show you how it stacks up against the other safe money inside your portfolio. So when you pay a premium into these insurance contracts, that was a terrible start. When you pay a premium, right, into your cash value, they're going to take out the cost of insurance, COI. They're going to take out fees. Okay, this is to manage the money. And the rest of the premium is going to go into the cash value. Okay, great. Now this cash value with an IUL, that is going to be growing with an index. Usually for most people, it's going to be the S&P 500. Okay. It's not invested in the index, but it is growing. The growth mirrors the growth of an index, right? So it's going to be somewhere in between 0 and 10%. You're not getting Bitcoin returns here, okay? We are not getting Bitcoin returns. So 0% floor, you trade, unlimited upside for the 0% floor, the protection from market volatility. Now, you get growth. up to a cap, which in this case is going to be 10%. It's just standard 10% cap rate. I'm just showing not every single policy is going to be like that. There's going to be different caps. There's going to be lower caps. There's going to be higher caps. Just for this example, I just want to show standard 10% cap, right? Now, whatever the return is that year, that's credited to your policy's cash value, okay? So this process right there, it continues every single year, regardless of you taking a policy loan. That's because policy loans, they actually come from the insurance company, right? You're not taking a loan from your cash value, you're taking a loan from the insurance company. And when they give you this loan, they're going to charge you an interest rate. Let's call it 5%. Now, I have a video detailing this on my channel, so I'm not going to go too in depth on it, but I'm just going to show you a basic example here. Let's say that you have $100,000 in cash value and you want to take a $100,000 policy loan and you get a 10% return here. Well, that means that you would earn a $10,000 credit on the cash value. But again, it cost you the 5%. Now that 5% is going to be $5,000 in this example, right? For the $100,000 loan. And that's going to mean this loan made you $5,000. So that gets credited up there to your policy's cash value. Now, we can mix and match numbers and go through all of the specifics for the percentage and the interest cost and how that actually works out in reality. I'm not going to do that in this video because I have another video detailing it. So if you want to learn that, which I highly encourage you learn exactly how policy loans work, I have that on my channel. All right, so let's look at some actual returns inside of a policy. Now, disclaimer, this is not financial advice. This is no guarantee, nothing like that. This video is strictly for educational use only. So before making any decision about you, your financial situation, anything like that, consult with your trusted advisor, whether that be your financial advisor, your CPA, whoever your trusted advisor is. This is not financial advice. I'm not your financial advisor. Educational use only, okay? Now that we got the disclaimer out of the way, let's talk about this. So this is an IUL with one company. I'm not going to go over which company it is because there's many companies out there that are going to get similar returns. However, I'm just doing a safe money comparison. So if we look at years 2004 to 2023 in the average rate of return with the S&P 500, IUL, and a bond fund, well, with the IUL, even with the cap rate, let me make this a little bit bigger. I don't think I can make that any bigger. I'm going to get rid of that. With the IUL, even with the 10.5% cap rate, you get a 7.24% average rate of return. Now, that's barely lower than the S&P 500. It's about 2 points lower than the S&P 500, but you achieved it with 0%, or excuse me, you achieved it with no market volatility, with no risk of losing money due to market volatility. Again, I'm not comparing it to the S&P 500. I'm just showing you that you can get near market-like returns with basically no risk. But if we compare it to other safe money in the portfolio, like a bond fund, well, the bond fund, bonds have not been performing that great, right? And so over the last, over the last, 20 years, this bond fund that is more than likely what your 401k bonds are in, I'm not going to say the exact name of the bond fund, but that's just more than likely what they're invested in, 4.12%. But look at this. This is an important thing. This is your safe money. But look at 2022. The safe money in your portfolio in 2022 lost 13%. It was a 0% the year before, negative 0.7%. In 2018, negative 0.4%. 2013, negative almost 2%. So the safe money in the portfolio can still lose money, right? So I'm not comparing stocks in life insurance. That is definitely not what I'm doing here. And I'm not trashing any product. I'm not trashing the stock market. I'm not trashing mutual funds. I'm not trashing bonds. I'm not trashing anything. Each of these products serves a purpose, right? I would probably encourage you to consider, instead of stocks and bonds, consider stocks and life insurance. And like I detailed earlier in this video, this is what the wealthy understand, and this is why they're, the majority of them are putting life insurance on the balance sheet and inside their portfolio. And quite frankly, that's why you should consider doing that too. So, no, life insurance is not a scam. And maybe if it was called a 7702 plan by everyone, it wouldn't have the reputation that it does. But when we start talking about life insurance and, its proven track record and really how powerful an asset it can be for you, we're entering a different realm. So you got to be careful. Obviously, you got to work with an advisor that you trust. Now, if you would like any help with this, if you want to see what your numbers would look like and check out a policy or see kind of how this asset would work in your overall financial plan, would be more than happy to meet with you. You can find my information below. As always, hope you have a great day, and I'll talk to you soon.